It looked like a sure thing. They thought it would never fail. Whether it was the shiny dot-com stocks of the 1990s, the unstoppable housing market of the 2000s, or the explosive crypto boom of 2021, every generation has had their can't-miss investment moment. And every time, millions of dollars were lost. Not by gamblers or con artists, but by regular people, professionals, even billionaires who thought they were safe. This documentary is not just about the biggest investing mistakes in history. It's about why they keep happening and how you can build a financial mindset strong enough to avoid them. Let's get into it. In the late 1990s, the internet was new and investors were hypnotized. All you had to do was put .com in your company's name and your stock could triple overnight. Between 1995 and 2000, the Nasdaq rose over 400%. It wasn't about profits. It wasn't even about revenue. It was about potential and the fear of missing out. Companies like Pets.com, Webvan, and eToys had million-dollar valuations and Super Bowl ads, yet barely any earnings. By 2002, over $5 trillion in market value had evaporated. What was the mistake? Valuing narrative over fundamentals. We break down why PE ratios were ignored, how institutions fueled the fire, and how investors didn't realize the difference between speculation and investing. We show clips of investor interviews at the time, explaining why they bought tech stocks they didn't understand and why they held all the way down. Key lesson: hope is not a strategy. Housing prices always rise until they don't. We dive into the 2008 global financial crisis, how subprime mortgages, leverage, and blind faith in real estate created a financial bomb. We cover the rise of mortgage-backed securities, why ratings agencies failed, how ordinary people were sold homes they couldn't afford, the collapse of Lehman Brothers. And perhaps most importantly, we look at the psychology. People taking out multiple home equity loans. Investors flipping properties with no money down. Financial advisors promising 10% annual gains forever. Interviews with real victims, from middle-class families to high-level traders, reveal a common theme. We trusted the system. Key takeaway: understand systemic risk and why diversification is more than just having different stocks. Bill Hwang turned $200 million into $20 billion using swaps and leverage. Then he lost it all in 2 days. This chapter explores one of the most dramatic blow-ups in hedge fund history, Archegos Capital. We explain what total return swaps are, how Hwang avoided public disclosure, the role of major banks like Credit Suisse, Nomura, and Goldman Sachs, the collapse of Viacom CBS that triggered the unwind, the big mistake, overconcentration plus leverage plus opacity. Even seasoned banks underestimated how much exposure Hwang had. We show how you, as a retail investor, can fall into the same trap with margin trading or over-investing in a single sector. Key quote from the aftermath: if you don't know how much you can lose, you're already losing. FTX was one of the most respected names in crypto, until it collapsed overnight. We break down the rise and fall of Sam Bankman-Fried's empire, why FTX's connection to Alameda Research was dangerous, how billions of customer funds were misused, why regulators missed the red flags, and how even sophisticated investors like Sequoia and Kevin O'Leary were fooled. This is a masterclass in due diligence failure. We walk through how FOMO led users to ignore warning signs, influencers promoted without understanding the risks, and how trusting the brand replaced verifying the numbers. Key lesson: don't confuse branding with legitimacy. Chapter 5: Meme Stocks and Retail Frenzy. GameStop, AMC, and the Power of Narrative. In early 2021, the world watched as GameStop's stock soared from $17 to nearly $500. Reddit, TikTok, and Twitter lit up with stories of revenge against Wall Street. But beneath the surface was a dangerous truth. Most retail investors bought at the top and held too long. This chapter dissects how short squeezes work, the role of ARK or Wall Street bets, Robinhood's halt and payment for order flow, why social investing creates echo chambers. Real people share how they lost thousands thinking they were part of a revolution, when in reality, they were the exit liquidity. Key insight: your portfolio is not a protest. In 2022, the crypto world saw one of its most violent meltdowns. It started with Terra/Luna, a so-called algorithmic stablecoin that promised consistent value without fiat backing. When it depegged from the dollar, it triggered a $60 billion implosion. Then Celsius and Voyager, crypto lending platforms promising 15% interest rates, froze customer withdrawals. We walk through how algorithmic stablecoins were built on circular logic, the danger of yield farming without transparency, why platforms like Celsius were effectively unregulated banks. We include real investor testimonials, some who lost retirement funds, others who had their savings trapped for months. Mistake: trusting high returns without asking what powers them. If I can just buy at the bottom and sell at the top, that's the fantasy. The reality: even professional investors miss it. This chapter explores the myth of market timing. Why even missing the best 10 days of a decade devastates returns. Historical data on buy and hold versus timing attempts. Real cases of investors who panicked in 2008 and never got back in. We show a graph comparing. Investor A stays invested through ups and downs. Investor B jumps in and out based on news. After 20 years, Investor A ends up with 3x the wealth. Lesson: time in the market beats timing the market. Putting all your eggs in one basket isn't just risky, it's historically disastrous. We analyze real cases. Enron employees who invested their entire 401ks in company stock. Investors who went all in on Tesla or Bitcoin and got caught in downturns. We break down why diversification works and when it doesn't. The difference between conviction and overconfidence. How even great companies can suffer for years. Key concept: diversify your risk, not your returns. Every investor will make mistakes, but not everyone recovers. This chapter teaches strategies to bounce back, how to analyze what went wrong without shame, how to rebuild a strategy with better risk management, the importance of rebuilding confidence through education and small wins. We feature stories of real investors who lost tens of thousands, but turned the experience into fuel. We also cover mental health, the psychological toll of loss, how to separate self-worth from net worth. Closing thought: the mistake isn't losing money. The mistake is not learning from it. We close with the antidote to all these mistakes: a clear, consistent investment philosophy. This includes understanding index funds and why they outperform most active investors, how to use dollar-cost averaging to remove emotion, the importance of asset allocation by age and goals. We also explore building financial goals before building a portfolio, why boring often wins, how automation and time create the real edge. And finally, we walk through investor checklists from greats like Jack Bogle and Ray Dalio. Investing isn't about brilliance, it's about behavior. From the South Sea bubble to the Great Depression, from .com to crypto crashes, every generation thinks it's smarter than the last. But the emotions stay the same: fear, greed, FOMO, overconfidence. If you understand these patterns and yourself, you can break free. The best investors aren't perfect. They're patient, disciplined, and humble. Because in the markets, it's not the smartest who win, it's the most prepared.